Happy Friday afternoon, everybody. A warm welcome for joining today's webinar and seminar. The title is Green and Transition Finance Policy Evolution in China and the Impact of Pilot Zones, co-hosted by Hong Kong Academy of Finance, AoF, Hong Kong Institute of Monetary and Financial Research, HKIMR-CFA Institute Research and Policy Center, and Hong Kong Green Finance Association. And with the support from CFA Society Hong Kong and CFA Society Shenzhen. My name is Scott Lee, Head of Strategic Partnerships at CFA Institute, and I'm your MC today. The escalating impacts of climate change have made achieving net zero emissions a top global priority. This goal hinges on two critical pillars: advancing green industries and decarbonizing traditional carbon-intensive sectors. The rapid growth of green industries demonstrates that economic growth and environmental sustainability can coexist, offering a path to reduced emissions while creating new economy models and job opportunities. As one of the first designated green finance pilot zones in China, Huzhou offers a compelling case study on how local context drives sustainable economic development and green finance development. And in today's event, there will first be a short presentation based on a report recently published by CFA Institute, my colleague Dr. David Van Ive. And that report provides an overview of the lessons that can be drawn from the Huzhou case, followed by a panel of experts discussing the importance of international collaboration in the development of green finance taxonomy, as well as exploring the challenges and opportunities in transition finance. But before we dive into today's discussion, it's my honor to introduce Dr. Giorgio Finati, Head of HKIMR, to deliver opening remarks for us. Please. Giorgio leads the HKIMR, the Research Institute of Hong Kong Academy of Finance, and affiliate of the Hong Kong Monetary Authority. Giorgio, please.
Thank you very much, Scott, and Brenda, Fun, and distinguished guests. Ladies and gentlemen, good afternoon. Thank you very much and a warm welcome to everyone joining us in person and virtually. Today's event, as Scott mentioned, is titled Green and Transition Finance Policy Evolution in China and the Impact of Pilot Zones. This event is co-organized by the Hong Kong Academy of Finance with us, the Hong Kong Institute for Monetary and Financial Research, the CFA Institute, and the Hong Kong Green Finance Association. On behalf of the organizer, I would like to extend our appreciation to the CFA Societies of Hong Kong and Shenzhen for their support. And we are also delighted to welcome participants online from the ASEAN +3 Finance Think Tank Network. So in the face of global uncertainties, it is essential to recognize that climate change represents one of the most significant long-term challenges of our era. Achieving net zero is particularly critical for Asia because of its greenhouse gas emissions and the vulnerability to the impact of climate change. According to the International Monetary Fund, emerging and developing economies in Asia face an annual climate finance shortfall of at least $800 billion. In addition to this funding gap, the region also faces critical knowledge and expertise gap in facilitating green transition. Leveraging its strength as a leading international financial center, Hong Kong has positioned itself as a driving force in addressing the challenges of sustainable development in the region and beyond. In fact, over 1/3 of Asian green and sustainable bond issuances have been arranged in Hong Kong, and this is also the place where innovation meets green and sustainable finance, as demonstrated by the pioneering multi-currency tokenized green bond offering. As a leading research institute in the region on cross-sectoral financial studies, the HKIMR is proud to have published already 3 thought leadership reports on climate risks and green finance, demonstrating our steadfast commitment to advancing this important agenda. We are also eager to collaborate with practitioners, policymakers, researchers to delve into significant economic and financial challenges related to these issues. To this aim, we are pleased to see that the CFA Institute has recently published a very informative study on Huzhou Green Finance Pilot Zone, which set the stage for today's discussion. The next 1.5 hours will be particularly intellectually stimulating. We will begin with a keynote speech in a pre-recorded video from Dr. Ma Jun, Chairman and President of the Hong Kong Green Finance Association, who will share insights from his direct involvement with the establishment of the Huzhou pilot zone. Following that, Dr. David Von Eyff, the author of the Huzhou study, will present the key findings of his research. This will lead into a panel discussion featuring industry practitioners and policy researchers who will offer perspectives on transition-related finance across policy, research, financial innovation, and the real economy. I really hope today's discussion will foster cross-sectoral and cross-jurisdictional dialogue and experience sharing, which are both vital for our shared goal of transitioning to a green and sustainable finance. Thank you.
Thanks very much, Giorgio. And let me just briefly introduce the next speaker, Dr. Ma Jun, President and Chairman of HKGFA, for his keynote address. Dr. Ma is a prominent advocate for sustainable development and green finance, with significant influence both domestically and internationally. In mainland China, he serves as chairman of the Green Finance Committee and president of the Institute of Finance and Sustainability. In Hong Kong, Dr. Ma leads the Hong Kong Green Finance Association and contributes to various committees focused on green finance and sustainable development. Internationally, he chairs the Capacity Building Alliance of Sustainable Investment, in short, CASI, C-A-S-I, and co-chairs several global green finance initiatives. So let's take a look at Dr. Ma's remarks. Thank you.
Good afternoon, everyone. On behalf of Hong Kong Green Finance Association, one of the co-hosts of this event, I would like to thank all of you for attending the discussion on green finance policy in China with a focus on the Huzhou case study. I should also thank CFA Institute, Hong Kong Academy of Finance, and Hong Kong Institute of Monetary and Financial Research for co-organizing this event. The main discussion today will be done by David Von Eyff, a senior researcher at the CFA Institute. David spent, I think, a year visiting Huzhou quite a few times and produced this very high-quality report. And he will discuss why Huzhou, a Chinese green finance pilot city, could achieve so much in a matter of 7 to 8 years, and its lessons that's relevant to other jurisdictions. David's project was originated back, I think, more than a year ago when I had a conversation with him, and I said to him that Huzhou is the most successful green finance pilot city in China. It's well known in China, but not very well known in other parts of the world. Can you actually go there and write something about it and use your international perspective to study Huzhou and tell the international audience what you think? And now we have the great report. In addition to what David will tell you, let me spend just a few minutes sharing with you my perspective on Huzhou's experience. My observations are based on a lot of time I spent in Huzhou. In fact, I went there 20 times the last 10 years. My team has helped Huzhou in various aspects, and we, in fact, set up an institute in Huzhou. It's called Huzhou Institute of Finance and Sustainability, which I chair. Now, just 3 points. One is the history or origin of Huzhou pilot. This dated back to 2015. At that time, I was the chief economist of the PBOC. In that capacity, I was in charge of drafting the National Green Finance Policy Guideline. So in the middle of 2015, when I visited Huzhou, I had a conversation with the mayor. And the mayor said that, Dr. Ma, you are leading the green finance policy work at the PBOC. And why don't we do something like a local pilot to help you, to support your national work? With some local experiments, and experiences. I said, why not? Let's start, exploring the possibility of, making Huzhou a national pilot city with endorsement from State Council. So, end of the year, we began to develop a proposal on Huzhou pilot. Then the proposal sort of spread it to other parts, and eventually, in 2 years' time, 2017, 8 cities in China applied for pilots, and the State Council approved this 8 pilot cities in one go. So officially, the pilot started in 2017, but the work actually dated back earlier. After 7-8 years, since 2017, when the official pilot was launched, there are many, many achievements in Huzhou. Now, let me just give you a couple of examples in terms of the numbers. The green loan ratio in Huzhou is now 34%, which means that in the banking system within Huzhou, 34% of outstanding loans are green loans. And this number is 14% for China average, and it's about 3% for emerging market average. Now, for emerging markets, they're probably that most countries don't have taxonomy and statistics, but I think around 10 countries have them, and I collected all of them. Some are showing 1% green loan ratio, some showing 3, some showing 5. The average of emerging markets from those countries with data about 3. So Huzhou is 10 times, in fact, 11 times greener in terms of its loan portfolio compared with emerging market average. And the growth rates of green loans in Huzhou, it's about 40% every year since 2017 when the Green Finance Pilot City was launched or officially approved. And they developed lots of products, including all kinds of green loans, green bonds, green insurance, transition finance products, green deposits. And they even created a voluntary carbon market within Huzhou by actually asking the polluting companies to buy carbon credit from the bamboo industry. Now, moving on to the topic of success factors, which I think David will explain in detail, but from my perspective, I think these are the 4 or 5 key factors. One is leadership. The city leader, including the party chief and mayor, are very devoted in supporting a green finance pilot scheme. In fact, every generation of the leadership spend a lot of time coordinating different bureaus and different key organizations in the city to work on the green finance pipelines. So the signal of top guys paying attention to the issue is very, very important, I think, in mobilizing resource within the city. And they provide a lot of incentives. And the incentives are, in fact, only generate results in a few years' time rather than immediately. And that's showing the leadership's vision, long-term vision of developing economy into a greener one through finance. The second key success factor is that they're willing to provide policy incentive, which reduce the cost of green finance transactions. In most of places around the world, I think green finance are not developing very fast, largely because green financing is more costlier than the traditional financing because you have to do ESG rating, you have to label the green products, you have to collect a lot of data, you have to do third-party verification, and for transition finance, you have to do carbon accounting, and you have to monitor the indicators and all of these. All these are additional costs which make green finance more expensive than traditional finance. But Huzhou, I think the main thing they did was to reduce the cost of green finance to those below traditional finance. What did they do? They provide interest subsidies. They provide grants for green finance innovation. The government provided a free ESG database that covered tens of thousands of companies' ESG information. They did it for free and give it to bank for free. And they provide carbon ledger that covers like 10,000 companies. It essentially does carbon accounting for free for the company and sent to the banks for free. And they provide free transition finance templates, which is the transition planning template. And they put it on a website. Everybody can cut and paste. And they provide free training for company that's applying for green finance or transition finance. So all these free services massively reduced the cost of a transition finance. And in fact, our estimated that transition finance, green finance / transition finance in Huzhou is 10-20 basis points cheaper than other financial transactions without a green label. Plus, they did a platform matching green projects and green finance. In fact, someone looking for green finance from the government-owned platform can be matched with money within like hours, rather than spending few months looking for money. The third key lesson is a very good team, a very, very dedicated team in Huzhou, which originally is called the Finance Bureau or Finance Office, and now it's part of the government Secretary General. And this team, which I worked with for the last 10 years, basically is what I call investment banking team, but paid government jobs. And they're so dedicated and they work really 24 hours and 7 days a week. And just to give you an example, back about 3 years ago when I was leading the G20 transition finance framework, drafting within the G20 framework, I was asking Huzhou, can you do something to give G20 some case studies and raw material for case studies? And they said, yes, we will do it. Within 3 months, they produced the world's first transition finance taxonomy. And now they have a third version of transition finance taxonomy within 3 years. The last point is capacity building. They know that capacity is so important. They need the people, they need the specialties within financial institutions, and they need third-party service providers, and so on. So they create a lot of specialized teams within banks, within other financial firms, and they subsidize the creation of service providers, and they did a lot of free capacity building events in the city. So these are just my takeaway from working with Huzhou for the last 10 years, and also from my team's research, and hope these are useful for your discussion, and of course for your sort of exploration of relevant lessons for other countries, and including for this place, which is Hong Kong Special Administrative Region. Once again, thank you all for attending this event, and hope this event a great success. Thank you.
Wow. Thanks, Dr. Ma, for sharing such amazing key takeaways and success of the Huzhou case studies. And now, I'll pass the time to my colleague, Dr. David von Ive, a Director of Global Industry Standards at CFA Institute, to guide you through the Huzhou case report. So just a brief bio of David. He joined CFA Institute in 2021 as a sustainability specialist. He brings a combined 13 years of experience in environmental compliance, research, and sustainability. David, you ready?
Yes.
Over to you.
Thank you everyone for being here today and coming on a Friday afternoon. Also, thank you to our co-hosts, the HKIMR, HKGFA, and the HKAoF for helping us out with the venue, and all the coordination would not be possible without them. So as Dr. Ma mentioned, we started this project probably a little bit more than a year ago when we were at an event in Mongolia. And I think one of the reasons why we thought this would be interesting to do was at the time, Mongolia was thinking about how do they create their green finance system. And they were starting with trying to do a green bond issuance. But when you talked to the banks and the policymakers, they didn't have a lot of the things that you would need to make that attractive to investors. They didn't have a green building standard. They didn't have environmental regulations in place. So there wasn't really the necessary policy support to make it happen. So the idea was, well, how do you create a green finance system? And I think that's a very important thing for many of the emerging markets that we deal with in Asia. So in terms of key takeaways, I know Dr. Ma mentioned a few of them already, but for example, like the importance of digital infrastructure to reduce market frictions. So speeding up loan times and centralizing information and standardizing the presentation of information. The systematic necessary capacity building. So I think I actually have that as my first most important factor, really. Even more important than everything else, because without that capacity building, you don't know what else you need to do. He mentioned the strategic use of incentives, and I'll talk about a few of those as well, but also the use of something like a pilot to prove a scalable model. So you can do these things within certain sectors or portions of your economy, so you don't have to deal with a large-scale failure if something doesn't work. So getting into it, why Huzhou? So if you're not familiar with Huzhou, they're a small province located about 10 kilometers outside of Shanghai, very close to one of China's largest lakes. And they're originally called the City of Silk because they were known for their textile industry. But they also had a very significant mining and agriculture as well. And while those were very important industries for them, they were also the cause of most of their challenges, predominantly around the water pollution in the lakes. Farmers were starting to complain that the hotels and the mines were polluting the lake, which affected their fishing. In terms of that, you also had kind of an increasing awareness in the public of the impact that these primary industries were having. particularly around lead pollution from their factories. Huzhou had about 216 lead-acid battery factories at the time, mostly single product. As I mentioned before, the hotels, that was predominantly untreated wastewater, which was also a significant issue. And due to that rise of public concern, you started to see the regulators take notice and also take action. So that created momentum that allowed them to kind of increase their regulation around environmental quality, which though had effect on the industries themselves. So you saw a significant decrease in the number of mines and batteries companies over time. Obviously, as they wanted to transition, they need to think about how do we do this in a sustainable manner. So that increase forced industrial closures. So you went from about that 220 to about 16 firms, right? That's obviously an issue from an employment perspective. So they thought about, how do we handle these trade-offs? So while that environmental quality was improving, how do we make sure we have employment? So they wanted to move from that primary to a more service-based economy. And that got them to think about how do we define green? Because at the time, there really wasn't a definition in China of what green should mean, and particularly what a green transition should look like. So that's where the Huzhou pilot zone context really emerges from. So while the pilot might have started in like the 2015 time period, really you have to go back to the 1990s to figure out why did they need to do this in the first place, and how did they get the kind of public will to do it. So in that 15 years prior to the start, you really went through two phases in the Huzhou economy. So in that first phase, you saw that lack of environmental awareness, but in phase two, you see a shift towards more tourism and local cultural industries that leverage kind of those neglected natural resources. But that phase two does see challenges in balancing those competitive needs of economic growth, employment, and addressing urban-rural income disparity. So they needed to move on to what they call their phase three, but that presented a number of challenges for the local government, including that determination of what is green, how do you get public buy-in, and how do you finance these transition efforts? So the first was really emphasizing capacity building. So green finance, as most of you probably know, requires a wide range of knowledge and expertise, including environmental science, law, engineering, and other topics. So it's quite broad. But how do you build that capacity in your area? So they started actually with the municipal government itself. So in terms of how they approached it, they started with actually training the regulators. Right? So you had the top-down approach of training from the municipal down to the rural level. That way they could kind of create economy of scale over time, but also have initial buy-in. And as the regulators were trained, they then rolled that out to the banks. So the banks could train their internal employees, and then the banks in turn could train the SMEs. Because Huzhou's economy is predominantly SME or micro enterprise based, which presents some further challenges that we can get into on the panel. So in terms of that, Dr. Ma mentioned they created quite a lot of different incentives. So Huzhou's approach was never to be regulatorily driven. Their goal was to do this through market-based incentives. And I'd encourage you to read the paper because I don't want to go into every incentive. But they had about 20, I think it was over 20 total policies aimed at green finance towards different sectors, et cetera, including incentives around getting SMEs to cluster, which helped reduce their own costs. But we can, again, I think, save some of that discussion for the panel. But they were really focused on market-based driven approaches, setting aside about 1 billion RMB for product innovation, talent attraction, and the development of their own green finance standards. If you're not familiar at the time, when they started their process, there was really no taxonomy in China. Then there were 3 green finance taxonomies, and then they finally settled on the final PBOC one. So in terms of how Huzhou went through this, you can see it, they created quite a lot of policy incentives for SMEs around loans, bonds, insurance as well, including the creation of such things like ESG insurance, which I think is a very unique product that aim to bundle together a lot of products at a lower price than buying each product separately. Because the goal was for the insurance companies to do more business with a single customer. So you're shifting the product from kind of an individual single risk evaluation to a comprehensive approach to address the company's full transition finance needs. But that's also generally a challenge for an insurance company because it's a lot of different products. So their goal was to just, what can we do to meet the SME's needs more easily? So to ensure that the system was successful, they needed to speed up the collection of information and figure out how to easily identify green projects and improve access to green financial products for those SMEs. When they first started this, everything was done by hand, right? So loan applications, everything was done by hand. Over time, they iterated through different versions of these softwares. I think the current version is version 4 or version 5 probably by now. They didn't get it right on the first try, but their goal was to create something and then iterate it, not wait for the perfect version. So over time, these things did get better, and there are definitely some challenges on how you could export some of these models from a Chinese context to a different emerging market, but the structures are very transportable. So some of the questions would be about improving, say, third-party access or issues around data privacy that would need to be solved. In terms of that, local context is an issue that comes up quite a lot and is very important for emerging markets. We go into more detail on this in the paper in terms of political context as well, but local context around climate change is a very important thing to understand. And if you look at China, they followed a very similar trajectory to the US from the 1980s and 1990s, but much later. The US went through this from the 1950s through the 1980s, where it transitioned from an economic issue into a public policy issue. Where in China, it transitioned from a scientific issue more recently to an economic issue. So that affects how they see their policies. So understanding that lets you understand what they're aiming for with their policies in general. And you can see that approach particularly in the development of, say, the Common Ground taxonomy, which does try to harmonize with international approaches, but still is trying to respect the local context in China. And that leads to differences in a number of categories, such as the economic activities that are included and other features such as the do no harm criteria. So I want to make sure we get to the panel with time. So just some final takeaways. So to successfully develop a green finance system, there are a number of critical steps that must be taken. First and foremost, you need strong leadership and buy-in from the top. In the paper, we look at a couple other pilot zone case studies that were not as successful, and you can see how important that senior level connection is. So senior level commitment ensures that adequate resources are allocated and that clear communication channels with higher levels of the government are established. So that key early priority also has to be capacity building because that lays the foundation for the long-term success. Both local expertise and international expertise are definitely necessary to develop a system that is effective and contextually appropriate. So reducing friction across the green finance system is also crucial, and this is where fintech can play a major role by streamlining data collection and improving the matching of capital to green opportunities. So like Dr. Ma mentioned, the search time for finding a green loan in Huzhou has decreased significantly over time with different iterations of the software. And that lowers both the search cost and creates a more competitive environment. Traditionally, a company would be going to different banks to go for the loans, but in the Huzhou system, banks are bidding on the projects, which leads to overall lower costs for the SMEs. So also, you do need a wide variety of green financial products to make sure you're meeting those diverse market needs. So ultimately, the goal should be to create a self-sustaining market that functions without the need for ongoing incentives. And I think we can get more into that on the panel. But I will leave us there and let us get to the more interesting part.
Thanks. Thank you, David, for the insightful sharing. And please remain on stage as we are moving on to the panel discussion. We're doing some setup right now. There are obviously a lot of great insights, great examples that's covered by David and Dr. Ma in the keynote speeches. For those of you who are interested in reading the paper, it's available on the CFA Institute website. Just go onto our website, look for it, download it for free. And next, let me introduce the moderator of the panel, Mary Leung, Senior Advisor of Research and Advocacy in Asia Pacific at CFA Institute. So Mary is a distinguished advocate and speaker for a wide range of capital markets related topics. She has over 20 years of experience in the global financial industry with expertise in corporate finance, wealth management advisory, and institutional fund management. Joining Mary, there's David, obviously, and then let's welcome Tracy Wong-Harris, Executive Vice President to the stage, and Dr. Laura Briggs-Fermor, Deputy Group Head, Macro Financial Research Group, ASEAN+3, Macroeconomics Research Office, who's joining us virtually from Singapore. Now, Mary, let me pass the time to you to introduce the panel speakers. Thank you.
Hello, welcome everyone. Very good to see all of you on a Friday afternoon. Whether you're here with us in person or tuning in online, we're delighted to have you with us. Before we start, I would like to do a quick pulse check with our audience in the room today. And this is how it's going to go, okay? I'll be saying a phrase, and if you know what that phrase means, please put your hand up, okay? Don't be shy. So put your hand up if you know what the phrase means, okay? Let's go. The first phrase is green bonds. Very good. Please put your hands down. Ready for the second one? Carbon credit. Very impressive. Mm-hmm. Now, the next one is ISSB S1 and S2 disclosures.
Wow.
Wow, we have a very informed audience today. And I have a last one for you. Transition, taxonomy, alignment with sectoral decarbonization pathways.
Wow.
Right, that's what I thought. If your hand wasn't up just now, don't worry. You are in the right room. You are in the right place. We'll soon fix that. So for much of the past decade, green finance, clean energy, green bonds, ESG investing has captured the limelight. And last year, the global green finance market was valued at $4 trillion US, with projections to reach 29 trillion in the next 10 years. By contrast, transition finance is like the poor cousin. Cumulative issuance is only about US $15 billion, and this means a huge financing gap. So annually, the financing gap is estimated to be about $3-4 billion US. But why is it important to grow transition finance? Well, transition finance is essential to help carbon-intensive sectors become cleaner. So when we think about hard-to-abate sectors like steel, like cement, manufacturing, transport, they're going to be here with us for a long, long time. And there must be pathways to help them decarbonize. So today, we're going to unpack the actions needed to scale up transition finance, drawing into research and real-world experience. Then we'll move on to the most common challenges and how we can overcome them. And finally, we'll explore how transition finance can be an engine of growth and how we can unlock some of the business opportunities. So whether you're a policymaker, a researcher, investor, lender, corporate decision maker, we hope that we can give you something tangible to take away with, whether it's just an idea, whether it's asking the right questions, or even a solution. So that's our KPI today, okay? So we've welcomed our panelists. So what I'm going to do is to ask each of you to quickly introduce yourself and highlight the parts of your career that are most relevant to the audience today, given the discussion we're going to have, and the perspectives you bring. And Tracy, I'm going to ask you to start.
Thanks, Mary, and good afternoon, distinguished guests, ladies and gentlemen. colleagues and friends. My name is Tracy Wong Harris. I'm the Executive Vice President of the Hong Kong Green Finance Association. I'm also a sustainable finance practitioner serving clients across Asia. Delighted to be here today speaking on this important topic of transition finance, and thank you for HKMA for hosting and also the organizers for today's event. And my relevancy of this, okay, so I guess from the Hong Kong Green Finance Association's perspective, this has been established since 2018 and working closely with the government's regulator and the industry to really drive and position Hong Kong as the international finance hub. And also being a sustainable finance practitioner, so I've been serving clients across Asia, across thematic and across products. So happy to share more during the conversations later. Thank you.
Thank you. And then let's move on to you, David.
Thank you. So as I was previously introduced, I'll think of something different to say about myself. But so while I do work for the CFA, in terms of my work there, we do quite a lot of work around net zero and transition finance from that perspective. But then in terms of like the research in particular for this paper, even though I work for the CFA, my background, as some of you may know, is not in finance. I come from an ecological economics and public policy background, so pricing natural resources, carbon, and externalities. So I've done a lot of work, especially with like the Hong Kong government, around policy topics for natural resources. So that's, I think, where my perspective comes from.
Excellent. Thank you, Tracy. Thank you, David. And online, joining us online virtually, we have Laura. Laura, over to you.
Yes, thank you, Mary. Can I be heard? Okay, good afternoon, everyone. Firstly, thank you to the HKIMR for the opportunity to join and participate virtually in this event. So I am Laura. I'm the group head for macro financial research at the ASEAN Plus 3 Macroeconomic Research Office, or AMRO. Our office is here in Singapore. I recently joined AMRO, coming from 17 years of experience at the Central Bank of the Philippines. At AMRO, MFR is tasked to conduct in-depth policy-relevant research in long-term structural issues such as systemic risks, risk to financial stability, population aging, and of course, climate change risks. So under this strategic direction, the team that I'm leading in AMRO is tasked to build a body of research and approaches in the study of climate change risks and sustainable finance and its impact to ASEAN Plus 3. Of course, with a view to providing the necessary analytical tools and policy advisory for our 14 member economies. Thank you, Mary. Back to you.
Oh, thank you, Laura. So we have three distinct yet complementary perspectives from policy, finance, and the real economy, so that's perfect for today's discussion. Let's begin with the big picture. Transition finance may be gaining traction, but scaling it up across Asia requires clarity, coordination, and credibility. So how do we move from commitment to capital deployment? And my first questions are to Laura. So Laura, you've written extensively on this topic through AMRO's recent transition finance report. So to set the stage, could you please walk us through the key distinctions between green and transition finance, and why transition finance is so important at this juncture?
Thank you for the question, Mary. Actually, there is currently no universally accepted definition or systematic categorization of the various types of finance. And in fact, that is the main reason why there's some overlap between entities that loosely define their bond issuances, activities and projects as green, climate finance, sustainability-linked, or biodiversity-linked. Because of this lack of standardization, this in turn leads to greenwashing or even transition washing, which simply means the practice of a firm or projects claiming they are green or are transitioning, but in truth, they are not. So in our BOAO collaborative report in March, we attempted to have a first pass at defining these different types of finance. Sustainable finance is the broadest category, which encompasses funds that go into activities that integrate environmental, social, and governance, or ESG factors, in alignment with UN's SDGs, or Sustainable Development Goals. Under this big umbrella, green finance are investment products that primarily support projects and assets that are already environmentally sustainable, such as renewable energy, energy-efficient infrastructure, and circular economy initiatives. As a subset of green finance, Climate finance, meanwhile, refers to financing instruments targeted specifically for mitigating climate change effects and supporting adaptation efforts. Finally, transition finance are funds which are designed to facilitate the gradual decarbonization of high-emission sectors, industries, and economies that are not yet fully green, but are making efforts towards carbon reduction and more sustainable activities and practices. Specifically, transition finance addresses the current gap, as you mentioned earlier, in funding the required shift to lower carbon production and cleaner energy alternatives. So in this juncture, transition finance is important because sectors like steel, cement, chemicals, aviation, shipping, and fossil fuel-based energy are among the largest emitters of greenhouse gases, or carbon dioxide. Without decarbonizing these sectors, achieving net zero is just mathematically impossible, as they account for over 30 to 40% of global carbon dioxide emissions. Transition finance is important because it would drive the research and development, innovation, and investments necessary to reduce these emissions as close as possible to the nationally determined contributions or NDCs set by each economy. Thank you.
Thank
Back
you, Laura.
to you, Mary.
Thank you, Laura. So, Tracy, you are, as you mentioned, you are a practitioner of green and sustainable finance. So, are you seeing what's working and what's not in real time, and what are some of the latest solutions that you've seen to allow transition finance to be scaled up?
Thank you. And thanks for Laura for laying the ground of the definition of green and transitions. And I'm going to take a step back to speaking from the practitioner. So if you look at green and sustainable finance debt market today, the thematic is, I call it green to rainbow. So many people heard me speak, always hear me say green to rainbow. What does it mean? So from green to blue, social, sustainability linked, transition to adaptation. So all this thematic today. And I think it's important to recognizing we have different thematic across the, can be laid across or wrap around different instruments of accelerating capital. And when we talk about transition financing, I also make a distinction of are we financing a high carbon intensive industry to make their way to low carbon? Or are we talking about a strictly speaking transition finance label? It's very different. So what do I mean by that, and how I see the market has evolved, and what are the instruments that is I see helping the real economy to make progress into transitioning into the low carbon. So from the earlier points to mention, putting transition label aside for now, I see over the last few years a sustainability link type of instrument, typically in the loan format, sustainability-linked loan, has made really good progress in helping real economy to transition to low carbon. Why do I say that? Because this is a more kind of transparent sustainability-linked instrument that often tied to carbon emissions reductions. And with a robust structure, it actually can help to make progress and incentivize the borrower or the corporate to make real progress in reducing their carbon emission reductions. For the last, I think the sustainability-linked loan is a phenomenon. It's about a 4-year plus. And it has actually taken big share, big portions of the total market size. And a fun fact, in Hong Kong is about half of the total sustainable finance debt market, half is in sustainability-linked loan format. So this is quite incredible with the progress made. And going to down a little bit deeper about how sustainability-linked help the economy, a real economy to transition. Often, the borrower are tied to a GHG reduction. So we see, of course, the robust structure, you will look at, okay, what does the international in that industry decarbonizing, and how their peers, and how their own progress. So it allowed the entry points of different sector or industry to come in to get financing and get incentivized for reducing their carbon emissions, from manufacturer to shipping to even very recent transaction on private hospital. Because you can see every single industry have that carbon emission reductions opportunity. And where the instrument is asking is you need to do better than your past. You need to make progress and ambitious target over the term of the borrowing. So really that is a good instrument. And it doesn't just need to be in a loan format. It can be done in a cash product, liability product, derivative product. So the same structure that to incentivize the reduction, carbon emission reduction, can be applied to different product set as well. So I see that as a good tool that has been helping the industry to making progress into a transitioning to a low carbon industry. Now moving back to, I think, the difficult conversations or difficult or more nascent segments of, strictly speaking, transition finance label transactions, which is still super nascent. I think that goes to Laura's point about because we don't have a internationally recognized taxonomy or principle, like the green loan principle, like green bond principle, per se, to create that transparency and confidence for the investor to invest it in. But we are seeing progress, and we are seeing different market center country like Huzhou making that taxonomy coming through to help the transparency, and more importantly, from investors coming in knowing when I actually put money into a transition finance label, what that actually means. Where I see growth in this area or in the past, we see shipping industry, like dual fuel ship is been picking up, and steel industry, like scrap steel, etc. So they are making into transition label, and we see more and more industry coming through. But I think from like the power sector and also slightly coming through, but the flexibility or the options of choosing a link structure and a transition finance label, that's the choice to be made, and depends where you are. I mean, where the borrower are at their journey of their expressions of which kind of instrument is more appropriate to raise, but serving also the purpose of transitioning.
So I think that's actually very, I think that's given me a lot of optimism, right? Because despite the fact that the transition finance piece may not all be there, but there's already huge effort in making sure that we can be product agnostic so long as the targets are clear, so long as the the amount of reduction of carbon emissions are clear, then we're still attracting lenders and investors and other capital allocators. And I think that's a very positive message. Thank you. All right. David, you talked about some of the key lessons from Huzhou, and perhaps now it's time to elaborate on those that you didn't have a chance to. So in terms of the key lessons from Huzhou and how perhaps emerging markets in Asia can learn from Huzhou, what would you say are the key lessons?
Sure. So I think the first one, like as I mentioned, is to me the most important one was capacity building, right? Because capacity building has a lot of knock-on effects that I think we sometimes don't talk about. Because if you think about when they were in the beginning, right, like they were creating their taxonomy, along with the national taxonomy at the same time, how do you know yours is good, right? So they had to show by their own training, how do they communicate? So in terms of knowledge building, you also create credibility. Right? So if you look at what they got into their taxonomy and was approved at the national level, they managed to include textiles and some of their mining work, which would normally not be allowed. And some of the other pilot zones were not as good at doing that. And they didn't just do it because they said, these are important to us, so we need to have them in there. They said, how can we justify it, right? So if you look at their textile rules, they're actually stricter than the national level. So they have requirements around zero liquid discharge, heat recovery requirements. For their mining sector, there's basically everything needs to be electrified as much as possible, right? So doing as much emissions reductions as possible. So starting with that capacity building approach is quite important. There's also, I think, that lesson of the importance of narrative. When I started my presentation, I talked a lot about their previous environmental work. So if you can't just start with green finance, right? You have to start with why do we have to do this? And if you start with issues like climate change and temperature rise and sea level rise, you're not going to get much public buy-in, right? You have to tie it to how is this going to improve our industrial sectors? How is this going to improve employment? How is this going to improve public health or welfare? Then you can move towards bigger topics like climate change. And if you look at their sectors, they went from 220 battery manufacturers to 16, but the remaining 16 provide more of a tax base than the 225 did because they're much more efficient, they have more product lines. It created some opportunities for them to deal with international firms that previously they wouldn't have got business with. So paying attention to that capacity building part and also the need to respect local context, but still also learn from international context. So you can have two frameworks that can work together. So I think that's one of the most important lessons in the beginning.
And I think from what you've just said, they were able to put together the best of both worlds, right? So even though there must have been some pain in implementing some of those standards, they were able to grow the market and become internationally and locally profitable. And I think those are very important lessons as well. So we've explored the ambition. Now let's talk about the challenges. So David, I'm going to stay with you. I know that there have been some challenges that you have also been exploring. Can you elaborate on some of the pain points you've encountered and how were they addressed?
Sure. So I think in terms of pain points, one was definitely cost, right? So Huzhou's economy is 80% or greater SME. And it's really more so micro than SME. So the ability for them to absorb reporting costs, et cetera, is quite low. So one of the first challenges is showing what is the opportunity of this, but how do we minimize the cost of this? So they addressed that in a couple different ways. One was through the digital systems to kind of automate data collection so companies don't have to report. Some of this would be difficult to do outside of China, but because of the way that their systems are set up, they can get information directly around energy use, exports, et cetera, so they can calculate your emissions for you. They know your imports, et cetera. They also deal a lot with kind of combining industries. So instead of each industry needing to go out and get consultants, the banks would organize around that and train their customers, right? So the customers didn't have to go find the consultants themselves. They'd train their own ecosystem, which lowers the cost, right? You only have to hire one firm or one consultant. Then you go through that one sector, and then you go to the next, et cetera. So that kind of systemization of approach helps lower that cost. In terms of their own costs, they knew they needed to transition to new industries, and that creates costs for the municipality as well, right? So they tried a tech park approach. So if you're like a clean concrete company, if you're in renewable energy, they cluster those in certain areas. And that allows them to reduce costs around waste collection, wastewater treatment, monitoring, et cetera. So those kinds of systematic thinking approaches were very important to dealing with some of the higher level challenges.
And from the time when people started investing into some of these projects to when they saw tangible benefits, how long was that time period?
I think probably project dependent, but we visited a couple different projects. I think one of the more interesting ones is one that would normally not be considered, I think, investable, which was a bio kind of remediation project around like a copper mine. Now that one I think had a 3 to 5 year payback period, if I remember correctly, which is quite short. Yeah. But that was a interesting mix of like a public-private partnership where they had a abandoned copper mine, which is a pretty large environmental hazard, but also a social hazard, right? People can get injured. It has pollution is an issue, et cetera. And from that, they combined it with, it's a 50%, I believe, private company and 50% village-run project. Village shares in with the proceeds from the park. And now it's like a social media destination, right? So it's funded through visitors coming to like get cups of coffee and hang out. But the villagers can use it for free. So they can go there to sell their goods, et cetera, for rent free. The business makes the money through the ticket sales, but as part of the loans, they did quite a lot to improve the area, right? Because you had to improve the roads and other things as well. It also created some pop-up industries. So it attracted people to come in and create like bed and breakfasts, et cetera. So there's a lot of kind of knock-on effects around like ecotourism that have come as a result as well.
Okay.
So that kind of maybe blended finance approach is quite interesting.
Okay. Well, that's a good segue to, I think, what we're going to discuss with you, Tracy, because obviously you want to be supporting your clients and you want to help them in their decarbonization journey. So from a banking, financial practitioner perspective, how do you do that? Like, what are the absolute must-haves when you look at a project like that?
Before that, I want to say I've been to the site. So and they're able to turn a abandoned mining ground into like a social enterprise projects that serve coffee is 55 yuan per cup. So you can imagine, right? In China, standard is pretty high, but they have, I think one of their statistics, they have 8,000 visitors a day at peak. So you can imagine, like once you create so much like incomes and revenue by really doing good and doing well at that place. So it's incredible. I encourage you guys to visit Huzhou at that site. Coming back to your question, I want to also add on to the challenges as well on transition finance, because earlier, I also, of course, taxonomy is one thing that we mentioned, but I think because there's not a well-recognized approach, I think from different financial institution perspective, the way that we land and make it into transition finance label, it varies slightly. And in my experience, we look at two things. One is the taxonomy, and the other also looking at the company's credible transition plan. And that is actually the more difficult part beyond what is a taxonomy, because I think this is the big gap between what a green financing. Green financing can really, a renewable, a green loan, a green bonds, and it's very understood. But then for transition financing, beyond what is the eligible activities or asset that is under the transition taxonomy, you really look at the company's credible transition plan. Do they have a plan to go all the way to net zero? I think that is the challenging part, and that's where and it varies a lot between industries. So for example, shipping already have a very well-recognized international IMO decarbonization curve, which you can compare the company and alignments along the line with that curve, as opposed to, let's pick a transmissions tower sector. What is the pathway? Anyone know? Let me know, okay? So it's that kind of challenges when you're dealing with transition finance. And coming back to your questions on, I think we have some bank colleagues here. What bank nowadays need to do a lot more than bankers to really facilitate sustainable finance transitions, transaction along the way. So I guess within the firm, within the financial institutions or banks, you do need that expert, sustainable finance origination expert that facing the client, that really understand the client's sustainability journey to provide that what is the right solution, product to support them. That's one. And secondly, there's often very much the case across Asia in particular that the client's just not there. So do you have in-house support? So for example, in some of the banking example, we see ESG advisory where to provide early stage advisory on ESG disclosure, reporting, strategy. Like you would imagine, so this is a big force job, but actually banks, we also have that in-house, and even to the degree of ESG rating enhancement, that kind of advisory as that. And then for transition financing, we also have like a industry banking transition accelerating team within the bank to really advise our high carbon intensive clients on actually the pathway to that, where to buy asset, M&A, acquisitions, etc., to position. So we have different type of team, and also fundamentally about asking, how is a bank transitioning ourselves? And how are we looking at our scope 3, our finance portfolio to transition net zero? So within that, we have a net zero team to look at sectorial pathway to align to our net zero curve. And that's also kind of form a benchmark compared to what we finance our clients to our curve. Right. So I think this is within the bank, but then and that varies whether the financial institution have that kind of resources to have that many different type of extra services. But you can actually look outside as well. I think this is where the collaboration and partnership come from. And even today, so many of the organizers here provide a lot of training, certification, capacity building, etc. Right? So really, there's a lot of resources. But we do tend to collaborate in terms of capacity building, definitely with CASI, HKGFA, and CFA, and then also partner with think tank for some in-depth research as well, decarbonization research, etc. I think that kind of collaboration is also important to facilitating. And last but not least, on what is must-have, right? I think depends the resources that you have in the firm, but I think core from a financial institution's point of view, you do need that kind of expertise to provide a robust governance to look through those transactions. Because even if you are a firm that not proactively going after to structure and those transactions with your clients, you will have to look through whether you can approve those transactions that's structured by other. So from that, you do need that in-house governance committee to look through those structures to avoid being in a greenwashing position. I think that's very important.
Thank you. I think the last part particularly resonated with me because I think it's important to have the right governance structures, right policies in place to make sure, again, that the trust in all these instruments in the system can stay high. So thank you for that. Laura, I would like to ask you about the report that you co-authored. The report on the Emerald report on transition finance noted risks of fragmentation, uneven capacity, and disclosure gaps across the regional taxonomy. So what are some of the potential solutions have you that have been identified, and are there any low-hanging fruits that you would recommend?
Thank you, Mary. Thank you for the question, because I would like to bring the discussion up to the level of policy, and later on also share with you a bit of research that have some interesting results. So on the level of authorities in the region, they are progressively working on guidelines and regulations that support transition finance. And mainly on this is on identifying and providing clarity on the definitions of green and transition activities via credible and interoperable taxonomy. So in that sense, this is the low-hanging fruit, which is essentially what we have observed. At varying degrees, ASEAN Plus 3 economies have already established their taxonomies, of course, at different speed. Earlier on, the Plus 3 economies, which include China, Hong Kong, Japan, and South Korea, have led the pack in terms of establishing and implementing their taxonomies. And from then on, we see Indonesia following sometime in 2021. And then in 2023, the ASEAN taxonomy was developed with the help of Singapore. And from then on, the rest of the ASEAN economies followed suit, customizing their own taxonomies based on the ASEAN taxonomy. So I think on that respect, that is where the situation is when it comes to on the policy level. They have set up the taxonomy necessary, and in terms of these taxonomies, then it provides the use of ESG labels and ratings or scores based on these taxonomies that they can be relied upon. So when they can be relied upon, this could drive financing flows to support activities and therefore prevent greenwashing. But I'd like to also, and related to that, at the same time, it was important to ensure that climate-related financial disclosure standards are also aligned with international standards. But apart from that, I'd like to also share that in the case of developing ASEAN economies in the region. Right now, they have established taxonomies, but in terms of scaling up transition finance, they also need to grapple about the reality of the need for capital market development. What do I mean by that? Even before they can promote or encourage transition finance, a lot of these developing ASEAN economies, what we would term as, for example, the BCLMV, Brunei, Cambodia, Laos, Vietnam, to a certain extent, at varying degrees, they are, again, I can speak because we have conducted some discussions both on the private sector and the public sector level. In terms of capital market development, they at varying degrees, and in fact, when we conducted a preliminary research based on panel analysis of 10 ASEAN economies and testing what are the various indicators and variables that have promoted sustainable bond issuances. So when I say sustainable bond issuances, this would include climate bonds, green bonds, sustainability-linked bonds, and all the total that we get from the Asian Bonds Online website. And we found that two main category of indicators and factors are driving up or scaling up sustainable finance. The first one being proxies or indicators of capital market development. This includes private non-financial sector credit to GDP, as well as IMF's indicators for financial institution development and financial market access. So in a way, this makes sense. When you have well-developed capital markets, then you can expect an appropriate pricing of transition risk, and also the willingness and openness of financial institutions to share that risk with enterprises and projects that need transitioning to low carbon activities. Now, the second category of indicators that appear to have driven sustainable bonds in the region would be climate policy ambition. So what are proxies or indicators of climate policy ambition? First, of course, would be the nationally determined contributions, or the NDCs. And this, at least empirically, have shown that the higher the climate policy ambition in terms of NDCs, there's also a tendency for higher sustainable bonds. And another proxy or indicator for climate policy ambition, of course, is World Risk Index, which indicates vulnerability to climate change effects or impacts. So the higher the vulnerability to climate change effects, so there is also a drive towards increasing or scaling up sustainable bonds. So this is very preliminary, but I guess it also helps to put in the picture that before we can even proceed to scaling up transition finance, capital market development, and the commitment and climate policy ambition of authorities also play a role in scaling up transition finance.
That's I think, a very important point, because at the end of the day, a bond is a bond and equity is an equity, and you need deep and broad markets for them to kind of thrive. Okay, so I think we can now flip the narrative from challenges to opportunities. So this round is about momentum, it's about creativity, and making a bit of money while saving the planet. So how do we position transition finance as a growth engine? So Tracy, I'm going to start with you. Dr. Ma mentioned the ability to reduce the cost of green finance as a key driver in the growth in Huzhou. And so what are some of the innovative structures that you've seen, and what role can Hong Kong play in capturing some of these opportunities, especially as a regional financial hub?
Thank you. For people that know me, I can talk innovative products for hours. So I'm going to restrict to 3 examples. So I mentioned sustainability linked structure. So this structure is on a private equity fund. So private equity fund that are using a sustainability linked structure tied to ESG. And I share the pricing mechanism, but the governance is one lacking in many financing structure. But this one is look at how the fund do their due diligence, their ESG due diligence when they screening for their underlying portfolio company. And the E apply to how to stretch the underlying company into improving their carbon emissions reductions, even from disclosure, reporting, target setting to actual actions of reductions on the E. On the S is on the gender side, gender balance side. And holistically applying for all ESG on this sustainability link on the fund structure. And the pricing mechanism is if you deliver those targets, you get a pricing discount, like lower interest rate. And if you fail, it actually tied to a penalty for purchasing carbon credit that is aligned to the ICVCM CCP, core carbon principle. So this is a really, you get the carrot and stick in both ways and driving ESG along using a link structure. So, and this is not even new. I did that a few years ago already. So this has been replicated since across many fund structure. That's one. Secondly, I want to share this is from a corporate companies, their journey on how they use different product and different thematic to transform. So this is quite public. So Muyuan is an agriculture company, is a pig farm, meats produce, a pork producer. So they did a link structure that tied to, of course, their carbon emission reduction overall as a company, and also their renewable installations on sites in their sites. That's one. And secondly, we did a transitions financing facility for them to import low protein animal feed that actually will help to reduce the methane emissions of the pig. So that is a transition financing facility for this company. Last but not least, they were able to generate carbon credit on the back of the way that how they treat animal waste. Yes, so even that dirty waste can turn into additional income. So we were, like, as a financial institution, we were able to off-take this kind of carbon credit, and therefore they get extra income. So that is one, like, agricultural company transforming in their journey. And one more example is, this one is quite new. So we're talking about high carbon intense industry on sustainable aviation, so on aviation industry. So this is a British, this deal is also public, so it's a British Airways debt financing facility where as a bank, we're able to create a debt financing to face a carbon credit developer producing carbon removal credit, that type of credit, and then and on the back of an off-taking contract with a British Airways, and we were able to also use insurance to guarantee the performance of the underlying credit delivery. So with that structure, we were able to advance payment for the developer. We were able to also create certainty for, or at least a payout for British Airways for accepting this credit. So these are the innovative structure that is already available in the market. But the bottom line is, okay, the market is making good progress. However, the funding gap is still huge. We are facing a 100 trillion, 150 trillion gap. So we still need to super advance that. So if I may, I would want to also inject a more forward-looking view and what I want to see the product innovation to continue. So I think this is where I see more the I think people heard about 3P, the public-private partnership that resulting into seeing the JACP, Indonesia Just Transition Program, and in Vietnam. I think expanding that to add one more P to introduce a philanthropy money, the 4 Ps in, to create more innovative financing structure. I think this kind of collaboration really is needed to accelerate the energy transitions. And we have seen a good example already that has been announced in Philippines, where to early decarbonizing existing coal-fired power plants by 2030 with 100% transformation from coal to renewable from there. And then to generate, and they were able to, Vera already announced a transition credit on the back of this facility announcement, meaning, what does it mean? I think my team at the back is laughing at me, it's too technical, and yes, but I think it's important to share this development. So this transition credit is to, however much that early decarbonizing and reduction of coal and generated into a transition credit to bring in another income to early decarbonizing to accelerate the transition. So I think that's the part. And I still have to answer the Hong Kong bit. Okay, so the product is done, so stop laughing, my team. So Hong Kong is already an international sustainable finance hub, has done tremendous amount of work. So I think at the beginning, HKIMR already saying that, you know, we are #1 sovereign green bond issuer in Asia. We are contributing to 1/3 of the sustainable finance debt. And so we are good at mobilizing capital. This is not just to decarbonizing Hong Kong, but beyond as an international sustainable finance hub. So what we are good at is continue to mobilize and innovate a lot of innovative structure. Like I mentioned, the sustainability link structure, like to unlock many different industry. Here we see over like half of the market already being raised in such structure. And also we have, like we mentioned, David mentioned Huzhou with incentive. And here also, so we have very successful grant scheme where to level out, you know, second party opinion, external validation costs from our MA. And also the government have grants to pay for trainings for people that want to go through the capacity building trainings, a 3-year programs that I encourage all of you to look at that, yes.
Excellent. And you know, there's so much happening, it's mind-blowing, and I'm glad that we have a role. Okay, next I'm going to go to Laura. In what markets or sectors do you see the strongest momentum?
Thank you, Mary. Actually, Tracy already mentioned one, and that is in the energy sector. So one primary example was what she mentioned, the early decarbonization of coal-fired plants in the Philippines was a major step. So that's just an example, because in the ASEAN Plus 3 region, there are substantial opportunities in going towards renewable energy because of the resources available. Let's say wind, hydrothermal, and solar are just a few of those possibilities. And so that there is huge opportunities for investments in the energy sector. In fact, according to the International Renewable Energy Agency, they've estimated that for solar PV, it will be a key to the region's short-term energy transition, and an additional 240 gigawatts of installed capacity will be needed. And this would entail an investment of $150 billion US. I think perhaps this is related also to what Tracy mentioned a few questions back. This is from 2018 to 2030. So energy sectors and facilitated by cooperation between ASEAN countries will be crucial in enabling the reallocation of capital towards these type of sustainable solutions in the energy sector. So if I may also point out the example of the ASEAN Power Grid, or the APG. It's a regional initiative aimed at connecting the electricity networks of ASEAN member countries. So the idea is that it envisions a fully integrated grid by 2045, facilitating cross-border power exchange and promoting the use of low-carbon energy sources. So right now, I remember that I recently attended a conference. I learned that Keppel Industries, for example, is one of the main proponents of the financing and investments into the infrastructure needed for the ASEAN power grid. And for the 2 years that they have invested, they have not seen returns, but they are happy and still willing to wait for the long-term payout, which I think is also very important to consider when we look at the availability and willingness of transition finance and moving it into projects such as this, which would entail, of course, long-term payouts. Now, currently, the APG is not yet multilaterally operationable, but there are some bilateral exchange of or trading in terms of electricity that's already tried out. In fact, what is called the Lao PDR Thailand Malaysia Singapore Power Integration Project began its first phase of implementation early this year as a pilot or as a sort of just a trial phase for the project. But I'd also like to mention another area of opportunity for emerging ASEAN economies is in critical mineral exports, given that the demand for these products are rising alongside EV and battery production in many technologically advanced economies in the region. So economies like Malaysia, Indonesia, and the Philippines, and also Vietnam, can take advantage of the surge in demand for these products that utilize critical minerals in the transition towards more renewable energy sources. And this is an opportunity that could help them surpass the costs of the transition by having the benefits coming out of critical mineral exports. So Southeast Asia holds major reserves of critical minerals, and this include nickel, cobalt, rare earth elements, and copper. And so the demand for clean energy technologies are now rising. And so if Southeast Asian economies can cash in and participate in the global supply chains of critical minerals, this can definitely be a source and an avenue of opportunity for the economies in the region.
Excellent. So I think we've had some very good ideas, both on the product side and on the sector side. We now have about 5 minutes for audience questions. And I know many of you are keen to join the conversation. And we are taking questions from the audience in the room and online. So if you have a question that you would like to ask, please raise your hand. We have a couple of microphones around. The lady there.
Hi, firstly, I would like to thank Hong Kong GFA, CFA, Hong Kong IMA, and for hosting and organizing this event. And also, I would like to thank panelists for sharing the insights. That's very helpful. This is Jia Yi from Morgan Stanley. I'm covering the climate stress loss in terms of the credit risk perspective. So my question is that in terms of green and transition finance mobilization, like David shared, I think the key is the capacity building and the knowledge building. And to do that, I believe that the government's funding of resource and talents is the key to start this entire journey and mechanism. So just wondering, I'm curious, can you share a bit more color on the government funding part, for example, like where is the government funding from, and how is the return of the government funding, and also how the government of Huzhou has successfully found and maintain those talents who can work 24/7 hours, maybe like as good as those audience who attend today's call and are willing to get the government's pay. So I'm curious about this aspect. Thank you.
I'll try to answer that as best I can. So I think, as I mentioned, they set aside about 1 billion RMB for various subsidies and activities, but they had various different ones as well. So for a lot of their green loans, transition loans at the kind of large bank level, they also had access to refinancing through like the PBOC lines of credit, which helped keep some of those costs down. But as you mentioned, like talent is quite complicated. There's a lot of competition, especially in China, for finance talent. So they did do a wide range of things. So for like attracting companies, they did do like that tech park setup. So for companies that were coming in and would be, say, starting the renewable energy, et cetera, if you were going to do it in one of those areas, you had preferential loan rates, you got cheaper utility rates, et cetera. So like one of the things that was actually a penalty for not meeting your ESG targets was you might actually have had higher electricity costs, right? So companies that met those ESG targets got lower utility cost access. In terms of attracting, say, finance talent to the areas, they did set up, through kind of the initial trainings, dedicated green finance area product lines in the banks. So for some of that, that was talent from other areas that came in, but they also created like housing incentives, et cetera, for people with certain backgrounds. So if you were to move into the area with proper training, degrees, certifications, you could be eligible for rent reductions and other things as well. So there was a very large basket of incentives they created. In terms of the return, I think it was, it's obviously product dependent, but I know they have seen a fairly good success rate with their loans. So even at the rural bank level, the rate that those loans fail is lower than traditional loans. So they did see a good payback on that.
Excellent.
Maybe I chime in here as well. First of all, it's not just the government's job to provide funding, but there's, as I mentioned, there's a lot of resources. And I think it's carrot and stick as well. So from banking perspective, since you're from banking, so MA already pushed out the GSF, Green and Sustainable Finance, ECF. This launched, this is the Enhanced Competency program, where the expectations, I don't want to speak for MA, but this is in the market. So the expectation is from a banking perspective, as a practitioner, there's some expectation that people that heavily dealing with fundraising, sustainable finance, need to have some sort of competency. So that's where the training certification is kind of required in a not mandatory yet, but encourage mode, right? So I think this is the expectation. And then, like I mentioned, on the back of that, it needs to have the ecosystem to provide this capacity and training for people. So for that, there's already HKIB setting out all the training programs for this kind of certification. HKGFA have certification program partnering with HKUST, and CASI provide really at low cost kind of practitioner training as well across. So there's lots of training available. On the back of that, the Hong Kong government has a grant subsidy program for bankers or even students that when you apply for this training certification program is qualified under their scheme, then they provide you a subsidy, a grant for you to take the course. So I think this is the ecosystem that we have in Hong Kong, and I really encourage everyone to leverage that.
Thank you, Tracy. So any other questions in the room? If not, I'll go to the questions online. Please.
Okay, again, thank you to the speaker. Okay, very insightful. I learned a lot. So for me, okay, come from the fintech sector. Okay, a simple, maybe a silly question. Okay, is regarding the data quality. Okay, so I think finance, everything is about the data, but compared to the traditional financial statement, okay, regarding the disclosure figure, I want to know about an audit or the verification process. Because recently I'm doing some research, looking at the same sector, even the scope 1, scope 2, scope 3, inside the same sector, the percentage can be a huge difference. So I want to look something about the tips or hints, okay, about the audit process regarding the data, especially for green financing. Thank you.
Is this something you'd like
Sure.
to
So I come in for this. Absolutely, data is essential. So I guess going back to the sustainability link kind of structure, every year the borrower need to present their KPI data to the bank, and those need to be externally validated. And for that external validation, so there is many environmental consultancy, Big Four, or assurance company, or second-party opinion to do that kind of work. And that external validation is part of the sustainability-linked loan principle. So it's essential to have that external validation. However, since you're coming from tech and AI background, I would just also to add, to reduce costs and increase the quality of the data, of course, leveraging, if we're able to leverage big data, it will be a big enhancement or advancement for the processes as well.
Okay, so a couple of comments online. Someone, I think his name's Lorenzo, he would like to share that the shading aspect of PV insulation could reduce heat by various temperature degrees, as well as reduce evaporation of water. And if this could be technically and scientifically parameterized and structured, it could be linked to green certificates, as well as discounted cost of debt. So that's another idea. Okay, one question from our online attendee. While the SMEs make up most of the economies in the Asia and Greater China region, it seems that they're being left behind in the transition finance area. Governments in the regions are hesitant to put a strict regulations on them because of poor economic situation. How can financial institutions help? And I know, Tracy, you know what the question is going to be. How can financial institutions help, given that you're the most important partners in the journeys? And I think perhaps, David, you can add to that from your Huzhou experience.
Sure. I think it's very good questions. I think from banking perspective, there is certain sustainable VPP program, so vendor prepay program. So I mentioned about sustainability link is a good structure. So in the SME perspective, we have seen multinational company working with the multinational company, we can overlay a sustainability link structure on how they look at their supply chain and how they look at their vendors. And from there, we were able to provide a little bit of kind of better pricing or interest rate, reduce the lending to the SME. Working with the multinational from that. So it's an existing kind of product structure, very similar to how a corporate to borrow sustainability-linked loan, get the pricing incentive. So in the SME space, there is this type of product. So look for those banks that provide this kind of services. But I think beyond that, this is a very good question. And I recognize, and even in from the Hong Kong government and from the Hong Kong MA perspective to provide help in this SME space. And also, this go back to data. I think the data, AI, and advancement to help to grab the robust data from the SME is also very important in order everyone to work on accelerating that journey.
Yeah. I think I can echo a lot of what Tracy said going back to the Huzhou experience, right? Because a lot of that came from cost reduction. So looking into how can we automate the data collection, et cetera, so we don't have to ask for that. But also in terms of economies of scale, each SME, going to each SME is quite difficult. So having the financial institutions go through the sectors themselves, so providing that kind of top-down approach helps minimize the cost for the SMEs because they don't have to find the consultants, et cetera. Providing templates. So the government can say, this is what we want from your sector, just fill this out, versus having them create their own reports. Creating kind of more automated verification is also quite helpful. Going back to sustainability linked, that's also quite important. And you did see a lot of sustainability linked things that we don't see outside of this area, like sustainability linked insurance KPIs. So instead of just raising your premiums after a storm, they can set a KPI around improving, say, your adaptation or resilience, so we can lower your premium, right? So they don't have to face necessarily increasing costs, but you can incentivize transition through lower costs.
And just to add on that survey, Hong Kong does have that survey as well, and I think it's working on the simplified version as well. Yes. So do look up the websites, and there is a SME ESG kind of survey to help. And I think this is where the standardization come from. It doesn't have to come up, the SME doesn't have to come up with this kind of survey, and it's publicly available on the website that you can try it on. And I think there is embedded with a GHG calculator as well for Hong Kong and Chinese company on that calculator as well. So, yeah.
So we have overrun, I'm sorry. I'm just going to leave everyone with one last comment from one of our online attendees, and then we'll close. Okay. So this comment is about, it's not a question, it's a gentle request. They're asking whether there would be a potential to arrange for an international study trip to Huzhou. And because, obviously they would find it's highly valuable from a best practice purposes. So this is from someone who's very eager to read the report. Okay. So that brings us to the end of today's session. On behalf of CFA Institute, thank you for being part of this energizing conversation. I would also like to express deep appreciation to all our partners for this event, the Hong Kong Academy of Finance, the Hong Kong Institute of Monetary Research, the Hong Kong Green Finance Association, as well as CFA Society Hong Kong and CFA Society Shenzhen. Big thanks to you and your team for your support and your collaboration. And that's how we are able to bridge perspectives across policy, finance, the real economy in such a meaningful way. And that's only possible through these partnerships. Once again, thank you to our panelists, Tracy, David, and Laura, for your generosity in your time, not just about sharing your expertise, but being so candid about the hurdles and your optimism about the future. So at CFA Institute, we're committed to supporting the energy transition, not just through our research and advocacy work, but through capacity building as well. And through initiatives like CASI, we are building pathways to help financial professionals and regulators and markets across the region to rise to the challenge of sustainable finance. Let's keep the momentum going. I'm sure I'll see you all again very soon. Thank you.
Thank you.